Welcome to Bunex Investment Group, a channel dedicated to make you a better trader. In this course, we are going to talk about everything you need to know in order to predict the forex market. This course will actually come in 4 parts, which are how to catch the high and low of a trading day with 90% accuracy. This is basically this first lecture. How to trade the weekly high and low using the average daily range or ADR, how to predict reversals using the Fibonacci, and the last but not least, how to predict the market flow using the commitment of traders report. So make sure you have somewhere to jot down some notes so that you fully comprehend the concepts. But before we jump into the whole video, make sure to subscribe to this channel if you haven't done so, and check the notification bell icon so that you not miss any of our videos. You may as well check our free signals Telegram channel where we share signals, analysis, and trading advice. Here are a few important facts that I need to highlight before we go deeper with these concepts. The market will not move in a calculable way every day, and there are some days when the market will always chop and do not move in any predictable way. This course will assume that you already know the basics of at least determining the market trend. So in this part of the 4 video series, we are going to talk about how to catch the highest prices and the lowest prices of a day with high accuracy. Before we dive into the concept, it is important for us to introduce a concept derived from the Elliott wave theory. The Elliott wave theory states that collective investor psychology or crowd psychology moves between optimism and pessimism in natural sequences. The mood swings create patterns evidenced in the price movements of the market at every degree of trend or time frame. So what we are basically trying to say is that the market itself is actually a representation or a reflection of what traders participating in it are doing. So this is the pictorial illustration of the wave theory, whereby we are saying in the Elliott wave, we say that the market moves in 5 waves. So by waves, we mean impulses or pushes. As you can see from this point, we had the first wave, right? A counter wave to number 2, then another wave to number 3, a counter wave to number 4, a wave to number 5, a counter wave to A, B, and C, and then continuation of the trend. So basically we will have 5 waves in order for us to dim or complete the template. So here is a few facts about the flow template or the waves that we have mentioned earlier. The market moves with a similar to the above flow template. So this template, this is how we expect or how the market usually or mostly move much of its time. The template we will look for must have only 5 waves within the market flow. Each wave of flow is constructed with either 3 candlesticks separated with a series of small green ones or 3 vector candlesticks. So what we are trying to say in these 2 points is we will only say the market is behaving the way we want if we see it making 5 waves. If not, we won't deem it satisfying our criteria. Each wave, for instance, wave number 1 separated wave number 2, wave number 3. So what we are saying is in this one wave, The wave is constructed by 1, 2, and 3 candlesticks, either separated with a small green candlestick. If it's going up, separated with small red candlesticks. In these zones there will be small red candlesticks, or there will be no candlesticks, and these will be vector candles. A big candle that stretches from this point to that point, another one from this point to that point, and the last one to complete what we call a wave. Wave 1 to 2 and wave 3 to 4 are called pullback waves. So we'll have wave 1 here and 2 here, then we'll have 3 here and 4 here. So 1 to 2 and 3 to 4 are called pullback waves, and they may be represented as consolidation with some spike moves. So we might not see a flow of the market from 1 to 2, but there may be some spike moves to 2 and some spike moves to 4. This is also true for the wave A and B. Is this so that from 5 we have A, B waves? So in the real market, this is how it will look like. It will never be perfect like how we were drawing. So this was high of this day. Days are separated with these black dotted lines. In this day, this was the highest point. From the highest point, we had 1, which is the wave from this point to that point. Then 2, which was a counter wave. From 2, we had up to 3 on this point. Then from this point to that point, wave 4. And from wave 4 to wave 5 is where it is much important, since that is where we need to actually get the low of the day. From 4 to 5, that is where we will get the low of the day. So this was the last. As you can see, we had a flow, then separated with this green candlestick, then another green candlestick. So 1, 2, 3 up to the last point, or number 5, to give us A, B. As you can see, this was the same level. We had A, B, and C, giving us the high of the next day. Don't worry, we are going to explain this on the charts so that you see clearly how everything is done. So here are a few steps of how to determine the HOD or LOD. So first thing is to find high or low of the previous days. Or if you are on the same day, you may have seen that this is the low or this is the high. What we want to trade or what we want to attain is the inverse of what we are seeing. If we are seeing high of the day, we need to anticipate low of day. And if we are seeing low of day, we need to anticipate high of day. So to attain the next high or low, we will need to we have to first satisfy our flow template first that we have talked about earlier. Our flow template is actually derived from the wave theory, as we said. So this is all done on the intraday time frame, which is the M15 time frame. And the concept of catching highs and lows should be used with some form of concepts of trend determination, which is basically taught in our advanced course. And trading off the highs and lows requires a setup. After determining that this is the high of day, we need to see a setup on that high. So let's go over the charts and see everything that we are talking about. So our first example is going to be coming from CHF against JPY. So we are going to definitely use all the concepts, and we are going to follow all the steps that we have mentioned when we were on the slides. The first thing is to determine the high or the low of the previous day or the current day that we need to analyze. As you can see from this day, this is the day that we want to analyze first, and you can see that we had our highest point. This was our highest point of this day. And from that highest point, we can see that there was the first wave, which is 1. Then from 1, we had 2. From 2, we had 3. And from 3, we had 4. And after we have 4, it is now important to see the 3 candlesticks separated with green small candles or 3 vector candles to give us the low of the day. So the low of the day that we were now looking for was this second day, and we can see that we had the first, right, small green candles, second small green candles, and then the third, which was, let me try to mark it. This became the low of this day. So on this low, we had we were now waiting. We could also trade off this low, or to actually consider our trend depending with our style of trend determination, but some actually take it off from that low of day. After seeing a low of day, what do we expect? We expect to see A, B, and C moves. However, the market did not give us that A, B, C moves. Therefore, we could actually enjoy this low, but we could not find high of this day due to lack of the A, B, C waves. Then after that, as you can see, this day actually passed. And on this next day, we could see that this was the high of this day, demarcated with these dotted lines. From this high, we can see that there was a phase where there was consolidation, and from that phase, we want to make it look like the template we need to see, the flow of market template. So we had 1, right, 2, 3, 4, and at 4, it's important for us to consider candlestick movements. Then we had 1 first vector candle, second vector candle, and third vector candle. Therefore, we could deem this as our low of day. This was our low of day. As you can see, it was actually issued. So from this low of day, we are now anticipating or waiting to see the AB move, ABC wave movement. However, the market did not give us a clear ABC movement. Therefore, there was no setup. Then after that, we could see that this was the high of this day. And from that high of this day, there was no flow of market template, right? Therefore, this was no longer valid. From the low, we were also expecting to see a satisfaction of the flow of market template, but it was not issued. Then on this day, we had this high, and from this high, we wanted to see satisfaction again of the flow of market template. We had 1, 2. After that, the market actually came and chopped. Therefore, we had 3 here. There was 3, 4, and at 4, we must see 3 candles or 3 candlesticks separated with small green candles. We had the first drop, a green candle, then another drop, then another green candle, and the last drop. Therefore, this was low of this day. As you can see, from this low, we now had number 5. We could also trade off this low, and from this low, we had number 5, A, B, As you can see, B was actually at this level. We had A, B, right? And B, since B was at this level, we are now expecting C. At B, it's important for us to see 3 vector candles, or 3 candles separated with red candles in this case, for us to reach the high of the day. And as you can see, we had 1, 2, and 3 from the B wave. At C, that is where we saw our high of day. This became our high of day, and we could trade off it. Let's go on another example. This is CAD against CHF, and this time we are not going to have a little bit of backtest, but we are trying to get what is actually moving currently. As you can see, on this day, on this previous day, our low was at this point. From our steps, we can see that this low had a consolidation. We had some consolidations that actually gave us the lowest structure of the previous day. We want to determine the highest point, or the high of this day. How do we do it? We simply try to satisfy our flow of market template. From this point, we had 1, right? A spike candle giving us 2. Then from this 2, we had 3, 4, and from 4 to 5, we need to see 3 candles separated with red, small red candles. In this case, we had the first one, a red candle, the second one, a red candle, and the last one giving us the high of day. So basically, that is what you'll be doing, and you can use this concept with other trend determination techniques, so that you actually get very, very good setups and very, very good entry points within your trading. So it's actually going to be complemented with the other parts of this course. On that note, we come to the end of this first part. You can ask questions within the comments section, and thank you for watching. Welcome to part 2 of our course. In the previous part, we talked about how to predict the high and low of day with high accuracy. We used a concept derived from Elliott wave theory. If you haven't watched that video, check it in the description below. Today we are going to talk about how to predict the weekly high and low using the average daily range as well as the Elliott wave theory. But before we jump into the whole video, make sure to hit that subscribe button if you haven't done so. Please also check our free Telegram channel where we share free signals, trading advice, as well as support. The link is also down below. Make sure you have somewhere to take some notes so that you fully comprehend everything we will talk about. So in this part, we will talk about the weekly Elliott waves, average daily range, or ADR in short, combining the Elliott waves and the ADR, then steps in predicting the high of week or low of week. You're basically wondering why we need to predict the high of week and low of week. Predicting the high of week and low and combining it with the concept of catching the high or low of the last day gives us the ability to catch sniper entries. Sniper entries will decrease the stop loss width and allow us to use higher lots, so make sure you watch till the end. So we'll talk about catching the highest point or the highest price that can be reached within the cycle. Firstly, we'll need to revisit the concept we introduced in part 1, which is a derivation of the Elliott wave theory. Then we'll talk about the average daily range. Combining these two concepts will give us an edge in finding a precise weekly reversal. So here is a Elliott waves in a weekly structure. Before we go deep, we need to reintroduce this theory. So the Elliott wave theory proposed the idea that market cycles actually resulted from reactions of investors to outside influences or the psychology of masses at that time. What we are basically trying to say is whatever we see on the market is a reflection of how traders are reacting to the movements of the support or the movements of the supply and demand zones. The downward and upward swings of mass psychology always had a repetitive pattern which are termed waves. So let's see the pictorial illustration of this theory. We have this weekly structure template, and this is the template that we'll try to fix in each and every market structure we see. Failure for the market structure to fit in our template is the result is to discard it. So the first thing that we need to see is to see these market flows or waves. The waves being equivalent to a period of a day. In this scenario, we have day 1, day 2, and day 3. Day 1, initiation, then termination. On its termination, that is where we see wave number 1. Then from this termination to number 2, it's a counter wave. And this can also be represented as a consolidation from this point to that point. And from this point to that point is the same manner from this point to that point. So for us to deem a structure valid, we need to see 5 waves in this scenario. 1, 2, 3, 4, and this can also be presented as a consolidation or a choppy region. Then 4 to 5, and then we expect a weekly reversal. Then from 4 to 5, that is where we now apply what we learned in part 1 to get or to anticipate high of this day in this scenario. So the above weekly structure template is the one that we will follow through all the time. We'll need to see 5 waves before anticipating the weekly high or low. Each forward wave, for instance, from 4 to 5 must cover at least a period of a day. The counter wave must also cover at least half of the previous day. But in some instances, they can be presented as choppiness regions. So the highs and lows of these waves, which are basically the highs and lows of days, can be obtained from the concept we learned in part 1. Then here comes the average daily range. The ADR shows the average pip range of a currency pair over a specific period of time. The weekly high or low mostly occurs at 3 multiplied by the ADR pips. This can be done with an indicator or manually, and I actually advise you to calculate it manually, because calculating it manually will give you an edge in calculating any pair or any tradable asset. So you can calculate it manually by obtaining the number of pips of the first wave. Actually, I had to write the first wave and the second wave, add them and calculate the average. That's wave number 1, then wave number 2, add the pips, then divide by 2, and you can now anticipate for wave number 3. So ADR is important to us because the IMF restricts movement of price to extremes so as to avoid a collapse of the market. We mean the International Monetary Fund restricts market makers to push the graphs in whatever amounts they want, because that will lead to crashing of the market. For instance, they are not allowed to push GBP against US 400 to 500 pips a day and the following day another 500 pips, because that will definitely crash the market. So every move must be backed up by a strong economic support. So with these facts in place, we would know that the ADR will hold. So this general limit to the ADR and involve moves as much as 200 pips per day in most pairs. So now let's go over the charts and learn everything, how to combine the ADR as well as the Elliott waves. Right, so this is USD against CAD, and we are going to try to fit in what we have learned. So the first thing that we need to see is a point of initiation. By point of initiation, we can simplify how we can see a point of initiation by looking at the H1 1350 crossover. That can give us a point of initiation. Then from that point of initiation, whereby we've seen 1350 crossover, we need to see 5 waves from that crossover. Anything that doesn't give us 5 waves is not of use to us. So let's take, for instance, this is H1 time frame. The first thing is we can see that here we had a 1350 crossover. So it means everywhere we had 1350 crossover from this from the past market flow, but none of those 1350 crossover gave us 5 clear waves, right? So this is for illustration's sake. That is why you are seeing it in foresight, right? So we are going to mark out. So from this point to this point becomes our first wave, and as you can see, after the first wave we had a consolidation, as I said earlier. So from this consolidation we can see that we have 1, right? We have 2 here, right? From this point to that point we have 3 at this point, and from this point we have 4. So we want to actually predict the zone of this weekly low. How do we do so? The first thing that we are going to do is we are going to measure the number of pips from the high to the low of the first day, which is 195 pips. Right, let me grab my calculator. 195 pips. Then from 2 to 3, how many pips did we have? 2 is at this point, then 3 is at this point. As you can see, we had 127, right? It's 127, right? So it's 195 for the first wave plus 127 for the second wave. Then we divide by 2, we got 322 at this point. So 322 divided by 2 is 161. So from 4 to 5 we expect to see 161. So as this day actually started, we wanted to anticipate or to predict this region, which is the low of this week. So we are going to put, this was the high, whereby we had 4 and the market was in play at this point. So this is 1.2415, 1.2415, then minus 161 pips. So this is 1.2415 minus 161 pips, an average drop that we got from these 2 drops, and our price will be 1.2256. I hope you can calculate some pips. That's 1.2256. This is the zone that we expected to see the market reversing. As you can see, at this point in this region, that is where we saw the market actually making a reversal. So let's have another example. Right, this is CAD against CHF, and as you can see, the first thing that we need to do is to look for 1350 crossover and see 5 waves coming after that 1350 crossover. Then wait and anticipate for the weekly high or weekly low. As you can see, CAD CHF from this point to that point, we had clear waves. I hope you are understanding. If you are not understanding this, please don't hesitate to ask questions in the comment section. So from this point, we had the first wave. As you can see, we had 1, right? Then 2, then 3, 4, and 5. So this actually was a valid structure or a valid template of the Elliott wave that because we had a 1350 crossover and 5 waves after that 1350 crossover. So what we are going to do is we are going to look back to backtest if we were going to manage to predict the last the weekly low. So from this point we can see that wave number 1 had 61 pips. It had 61 pips. Then wave number 2 had how many pips? 73 pips, right? 61 from wave 1, then plus 73 from wave 2, we get 134 pips. So 134 pips divided by 2 is 67 pips. So this was the high that was set, and while it was in play, we had to anticipate or predict this zone. So 67 pips, that is the ADR that we obtained from these 2 days. So we are going to subtract the 67 pips for a drop from this price, which is 0.7324. So subtracting 67 pips from this price will give us 0.7357. Let me mark it out. It's 0.7357, right? Sorry, it's 0.7257, right? As you can see, we managed to predict this was the low, and on that, it's either we could wait for a setup or whatever, but we enter opposite to the market flow whenever we get the low of the market. Then yesterday, I gave out a signal, right? After I saw that there was a 1350 crossover here, which is 1, 2, right? Sorry, it's 1, then 2, 3, 4, and from 4 we went to 5, right? And how I got to make a sell here from this point to that is we had the first wave. We had 102 pips, 102, plus then the second wave we had from this point to there, that point, it's 78 pips, right, which is 180. Both these waves have 180. So dividing by 2 to obtain the last length, we get 90 pips. So from this point, we are now adding 90 pips to 0.7358. So adding 90 pips to this price we will get 0.7448, right? And as you can see, this is the level that we had, which was a region, and I saw a pattern within this region. So basically, that is what you will be doing. The first thing is to make sure that you see a 1350 crossover on that H1 time frame. After seeing a 1350 crossover, you have to see at least wave number 1, number 2, number 3, and number 4, so that you'll be able to calculate the ADR of the anticipated peaks from number 4 to number 5. Then after that, you would see the market going to number 5, and at number 5, it's up to you to enter directly after a setup presents, or whenever the price touches that price. So for you to gain enough experience with this concept, you need to backtest a lot. Try to find the 1350 crossover, try to find waves number 1 to 4, then anticipate where number 5 was going to be. We come to the end of this video, and if it has helped you, please consider sharing it with someone. Welcome to part 3 of our course. In the previous part, we talked about how to predict the high and low of wick with high accuracy. All the concepts explained earlier now needs to be combined in order to predict the rightful market reversals. So in the first part, we actually talked about how to predict the high of day. Then in part 2, we talked about how to get high or low of the week. So those two concepts now needs to be combined in order to get the rightful market reversals. Today we are going to talk about how to predict the market reversal using the Fibonacci retracement tool. So this is now basically linking two different wicks. That is, after obtaining a high of the wick, we expect to see another wick initiating. But the point of that wick initiation, we will use the Fibonacci retracement tool. Before we jump into the whole video, make sure you hit the subscribe button if you haven't done so. Please check out our free signals Telegram channel where we share free signals, trading advice, and support. It will definitely help you here and there. The link is down in the description below. Make sure you have somewhere to write and take some notes so that you fully comprehend everything we will talk about. And do not hesitate to ask any questions in the comment section below. So in this part, we are going to talk about one, we'll just have a revisit of the Elliott waves that we talked about in the last part. Then we'll talk about the Fibonacci retracement tool. We'll have a definition of what this tool is all about. We'll also talk about the useful Fibonacci retracement tool zones. There are only a few useful zones and we'll talk about them. Then we'll go over the charts to show you how to expect and how to actually carry over the operations in real life practical examples. So in the last part, we talked about the weekly structure, whereby all the concepts were meant to give you the ability for you to anticipate and expect or predict where the high of the week will occur. So in this scenario, we talked about getting the average daily range of these 2 days in order to anticipate this, as well as using these number of waves, which are 1, 2, 3, 4. If you haven't watched that video, you may actually check. The link is down in the description below. So today we are going to talk about how to anticipate a point here whereby we initiate another week of rise, or if we are in a downtrend, another week of drop. So this is basically going to be this in summary. So we have a week of rise like this one. In this case, I only drew it as a straight line, but in actual fact, it will look like it will have these segments or these waves. So in this case, I only drew it as a straight line. So after this week of rise, we expect initiation of a second week of rise, like this scenario. So we are going to talk about how to predict this point, whereby we are now initiating another week. So it's basically catching the low of the next week after the first has been completed. So getting this point will actually give us an edge in actually getting all these pips, and as well as how to predict this point. So we'll basically have 3 weeks of rise. So these linkages are what we are interested in this video. So the Fibonacci retracement levels are basically horizontal lines that indicate where demand and supply zones are likely to occur. They are based on Fibonacci numbers, and there is a history behind these two. It was actually created by some guy who had, I'm sure, a name called Fibonacci, and he created from mathematical calculations. That's how he actually got these horizontal line values. So each level is associated with a percentage. This percentage is basically how much of the prior move the price is retraced. So let's take, for instance, the price has gone from A to B, then the price is retraced. So we are basically measuring the amount of retracement the price has given us. So let's take, for instance, the price is retraced to this point. We might say it is retraced 10% of the prior move AB. Or if it comes at this point, we would say the price is retraced 50% of the prior move AB. Or if it goes to this, we would say it is retraced 100%. So that is basically what the Fibonacci 2 will be helping us. So the Fibonacci retracement levels are 23.6, 38.2, 61.8, and 78.6. However, there are only a few that are of importance to us, and that is what we will talk about in this video. So here's how you can use the Fibonacci 2. So when these indicators are applied to a chart, the user chooses 2 points, which are basically a lowest point and the highest point. In our case, the first point is the low of the week. Then the second point is the high of the week. After obtaining these points, we now need to apply the Fibonacci retracement 2. So once these 2 points are chosen, the lines are drawn at percentages of that move. So let's take, for instance, we are saying we have our first week of rise, right, which has 5 waves, as we talked about in the part 2 of this course. Then after 5 waves, we say this is the point A, point B. We apply the Fibonacci retracement 2. It will look like this sort, and we'll have the percentages at this end. So although there are several zones on the Fibonacci retracement 2, only 2 are important to us, and these are the 38.2 and 61.8 retracement levels. Of course, there are a lot of retracement levels, but these are the only ones that are important to us. And as always in trading, we have to be consistent with our concepts. We do not need to change whenever we want, but we stick to the only concepts that we have. That is how we can stay consistent, even making money out of it. Algorithmic trading is the only answer to making consistent profits. So that is why we say 38.2 and 61.8 are the only retracement levels that we respect. So the sequence will be as follows. After week 1 of rise, right, we expect the price to retrace to 61.8. Then after week 2 of rise, we expect the price to come to 38.2 retracement level. Basically that. So the first thing that we have to do is actually to get high of this week using the methods that we discussed in part 2 of this course. After getting the high, we have point A, which is the low of this week, and point B, which is high of this week. Then apply our Fibonacci retracement level. Then at 61.8, that is where we actually put a zone to expect the market to come back in that zone, so that we'll actually make use of that zone. Then after week 2 of rise, we mark point A, which is the lowest point, or actually in this case, which will be 61.8 of the first week. Then the highest point of this week that we would have attained by the methods we talked about in part 2. Then apply the Fibonacci retracement 2. After that, we expect the market to come back to 38.2. After price reaches the 38.2 zone, that is where we start to look for entry opportunities. So let's go over the charts and illustrate how everything goes. So this is GBP against USD, and I'm going to use the 1 hour. As you can see, we are on the M15 time frame. I'm going to use the 1 hour time frame to do the explanation. So as you can see, let's start on the higher time frame so that it will be easier for us to see. From this higher time frame, we can also apply all the concepts that we have learned since part 1, and from that application we can see that this was another zone of initiation, whereby we are now starting to count the 3 weeks of rise as seen from our template. So after that, we go on H1. We can see that this week started at this point, and the high, let me use some highlighters, this week had its low at this point. This was the low of this week at this point, and this was the high of this week at this point. We could actually anticipate this high after the market had moved from this move. The first move, right? This was 1, 2, 3, 4, and 5. And at 3, we could actually anticipate this move and calculate how much pips we were going to expect at this move, and that was actually explained in the part 2 of this course. So after obtaining the high of this week, we expected the market to retrace to 61.8 retracement level, and using our Fib 2, this is point A, right, to point B, we can see that the market actually respected our concept to anticipate market reversal. This is where it retraced, which is basically 61.8. So as we said that after the first week of rise, we now expect the market to retrace to 38.2 after this move. So let's apply again on the next week. This was the following week, whereby we had 1, we had 2, we had 3, we had 4, then 5. And we could also anticipate this high of the week using the methods that we talked about in the part 2 of this course. So after having that, we are now applying our Fib2, whereby we expect the market to retrace at 38.2, and that is exactly what happened. So this was also a point that we were going to anticipate its reversal at 38.2. So basically this was to show you that these concepts hold. However, there are variables within the market. It's not something that is uniform all the time. Things change and structures change. Whenever these changes, we will need to look for application of the part 1 of this course, looking for the low and highs of days, so that we can be involved within the market in the direct direction of the market. So basically it will need you to open the mind, apply all the concepts that you've learned from part 1, part 2, and incorporate this part as well in order to have it as a complete guide. So that is what we were going to, that is what actually what I had today, what I wanted to show you. And we have come to the end of our part 3 of our course, and have a good day. Hello and welcome back to Bonex Investment Group. This is going to be the last part of our course, which is how to predict the forex market. So in part 1, we actually discussed about how to catch the high or low of day. Then in part 2, we talked about how to catch the high or low of the week. Then in part 3, we talked about linking 2 weeks, how to see the market reversal from 1 week to another. And if you haven't watched those ones, you can go and refer them on our channel. Then in today's video, we are going to be talking about the quarters theory, since I highlighted it in the first lecture, that we are going to talk a little bit about that concept in our fourth lecture. So this is basically a how to predict the market reversal in indices, commodities, and other trading assets like shares, bonds, etc. So before we jump into the whole video, please check out our free signals Telegram channel. The link is right below, and if you haven't done so, click the subscribe button so that you'll be notified each and every time I upload a new video. On that note, let's jump right into our today's content. So this is US 100, which is basically Nasdaq in other terms. It's a meter or a gauge of the top 100 companies in America, the performance of them combined and plotted on a chart. So it's a very high paying asset, but you really need to know what you are doing if ever you try to trade this instrument. So quarters theory is basically a theory that was designed by someone some years ago. I'm not so sure his name, but it basically says most reversals happens at whole numbers, which are basically a quarter derived from a data. So let me put into action what I've said. The first thing that you do when using the quarters theory is to basically go on the chart that you wish to analyze, and this is how it looks on H1. And the first thing is to see where the price is coming from. As you can see from this point, this is the lowest point, and it shows that price is coming from the 12,000 handle. 12,000 handle. So that's the first thing that I will do. After seeing that it's coming from the 12,000 handle, I would look for a whole number from that handle. In this case, the whole number is 12,000, and I can only see it if I go on the H4 time frame. So let me insert the 12,000 handle and draw a horizontal line on that value. So I'm going to input 12,000 on that horizontal line. So there we are. So Sorry about that. Let me correct the value. 12,000. Right. So from 12,000, that becomes our data. 12,000 becomes our data. And from that, we start to increment with 500. So from 12,000, we go to 12,500. We are now in the process of building the quarters. In this case, we are using these values because that's the scale of the instrument. So there we are now at 12,500. If we increment again with another 500, we'll have 13,000. But if we are doing this system on normal pairs, it means we will have a 1,000 pip interval. And by having a 1,000 pip interval, we basically use the same concept of finding a whole number where the price is coming from. Then segment that 1,000 pip range and into 250 pips. So for Nasdaq, it uses a different scale, and we are incrementing with 500. So from 13,000, we go to 13,500. Then from 13,500, we go to 14,500. Sorry, 14,000. So after doing this, we can see that we now have 1, 2, 3, 4 quarters. And the theory states that price reversals are imminent at each quarter level. So price reversals are imminent at each quarter level. So what we basically do is to try to find confluence at these quarter levels. After marking out like what we did, we can now go on the H1 so that we may see confluence of the market on these levels. So as you can see, I've marked this, and by confluence we mean a reversal setup at these quarter levels. So this was basically a level that we could actually anticipate before it actually happened, and a reversal setup was issued at this point, and the market went down to another quarter level. From on this quarter level, a reversal setup was also issued, and the market did this. Then after that, the market passed through this quarter level. In some instances, the market will come to retest and issue a setup to drop. But in this case, the market makers actually decided to issue a setup at this point. Then on this quarter level, which is 13,000, they issued another setup. So these quarters have names like major quarter, minor quarter, and so forth, but it's not necessary for me. This is the exact concept that really works for me. So as you can see from this point, the market went up, and so we could have this entry, another entry, and another entry, right? At this point, we can see that the market actually issued another retest at this quarter level, and it went up. So our next thing is now to see how the market is going to react at this quarter level. Is it going to issue a setup below this quarter level, or is it going to break and then issue a setup to continue going up? We do not know. We only react to what the market has given us. So that's basically what we do on the quarters theorem. There is nothing fancy about it, or nothing that is so special about this theory. It's basically marking out the chart first using a datum that you can determine by seeing where the price is coming from, then actually increment using a certain value depending on the instrument that you are analyzing. In pairs it works, but there is a lot of choppiness in pairs. So I've seen, and from my past experience, I've seen that this works properly on commodities, indices, and so forth. So before you use any strategy, you need to backtest it first. You need to see how it performs in your operations before you actually start putting real money on it. So that's what we had in our today's video, and we have come to the completion of our course, which is how to predict the market. And be sure to check out new courses as they come on our channel. On that note, thank you for watching. Like and subscribe and share with someone. It might help a brother or a sister.